help the proper foundation in trading. We're going to be diving a lot deeper today. On our previous video, FRX Beginner Bootcamp Part 4, we got heavily into the theory of price action trading, as well as the session before that, teaching you guys all about supply and demand levels, support and resistance levels, price reversal zones, trend lines, things of that nature. And a common theme within the price action world or within our previous classes was stop and reverse. As we're talking about interacting with trend lines, as we're talking about interacting with support and resistance levels, as we're talking about interacting with supply and demand levels, right? We began to touch on the notion of entries, where to enter in the market, how these levels can be used as entries. But today, what we're going to do is we're going to dive a lot deeper into the world of Forex, into the financial markets. And we're going to start off today's training by getting deeper into the understanding of candlesticks. So let's just begin with the training as per usual. So as discussed on, I believe, our first FRX Beginners Bootcamp, a candlestick is a type of price chart used in technical analysis that displays the high, the low, the open, and the close of prices for a trading asset over a specific period of time, depending on which time frame you have that candle open or closed on. Now, all we did was speak about candles. Today, we're going to be training on the candles. And before we get into the popular trading candle charts, I do want to share a notion with you, and it's that of this. When we're speaking, we have to know the alphabet. Alphabets create letters, A, B, C, D, E, F, G. When you begin to put those letters together, they create words. And if you string words together, you eventually form sentences. That's exactly how we like to interpret and understand the candles and the vital part that they play in the financial market. It's a very important instrument that you can use. Look at a single candle as an alphabet, a B, a C, a D. When you begin to put candles together, you can create these things known as candlestick patterns. Those are the words: bullish engulfing, bearish engulfing, morning star, shooting star, X, Y, and Z. Now, when you start to string dozens of candles together over time, these candles begin to tell a story, and those stories are the sentences in the market. This market is bullish, this market is bearish, this trend is reversing, X, Y, and Z. So you see, it all goes back to the candles. So understanding the candle is going to be one of your biggest assets when it comes to trading in the financial market. So let's get started by just jumping into popular trading popular trading candle charts. So we're going to begin over here with the bar chart. Now, the bar chart is a lot like the original candlestick chart. However, bar charts are typically used for stocks, stock traders, I guess, like that. They used to like to use bar charts many years ago. There are some people that prefer bar charts over candlestick charts. Now, the second type of popular trading candle chart is the typical candlestick, which is what you see right over here, right? It gives you a very clean reading: the high, the low, the open, the close, and signaling the body of the actual candle. Now, in addition to that, we also have something known as the Hikinashi candle. Hikinashi candle is another Japanese variation of the candlestick. And what it does is it allows traders to detect trending markets opposed to every single move in the market. All right, we're going to be getting into those within the market. Then we have something known as the line chart. So the line chart is a single line going across the price. You don't see the high, the open, the low, the close, the body. Line charts just help distinguish key swing points within the market, and it helps traders see price in a very clean way with no confusion whatsoever. Then you also have the Renko. The Renko is another Japanese form and variation that helps traders identify trends and reversals in the market in a block format. So it can be a lot easier to just see price movement. And last but not least, we have the line break candle, which many people don't often use, but the line break can be a very, very, very popular type of candle where it will provide trends in the market. And every time a trend begins to reverse, the candles will change color, similar to the Hikinashi, but in a different fashion. So with that being said, let's go on over to the actual chart and let's take a look at how these candlesticks look so you can see which candlestick would be most preferable for you. So now as we come over here to the chart, we can see right here that we have the typical candle. And each of these candles are giving us the high, the low, the open, and the close. And then this is where we're getting these bodies of these candles for. So as you see, it gives us all the data that we need in real time per candle, per time frame. Now, if we come on over here and we look at different candles, again, we can take a look at the bar chart, which is a lot like the typical candle, giving you all the information you need just in a different view. Once again, many stock traders like to use the bar chart. Now, moving forward, you also have the next popular candle known as the Hikinashi candle. Now, you'll notice with the Hikinashi candle, while it will also provide the high, the low, the open, and the close, you'll notice that the Hikinashis color the candles a bit differently. Now, the purpose again of the Hikinashi candles is to minimize the noise and help traders identify the true trend of the market. The Hikinashi candle itself is actually an indicator within the market, which is why many traders like myself and other popular traders like to use the Hikinashi candles. Now, moving forward, we also have the line chart. Now, again, the line chart is not necessarily giving you any specific price points within the market, but it's giving you an overall price reading so you can see clear swing points. This is a very, very easy way to help you identify price reversal zones, highs and lows inside of the market without being confused. And many popular trading strategies are based around the line chart as well. Now, moving forward, there is also a few other like the area and the baseline, which many people don't use in this type of trading. Now we also have the Renko. Now, once again, the Renko is another Japanese candlestick that is good for identifying trends and reversals, where many traders are looking for the green, green, red pattern as a reversal or the red, red, green pattern as a reversal. And they're trading the blocks and the trends inside of the market. This can also help you predetermine pretty valid swing points in the market as well. Now, moving forward, there are some other ones. Again, line, KG, point and figure, and the range, which again, we don't really use, but there is another really popular candle preference called the line break. And I think the line break is a very interesting type of candle. Now, the line break is not your typical type of candle showing you the open, the close, the high, and the low, but the line break helps traders identify when there is a line break in a trend and the market begins to reverse. So when you see the candles turn green, that means that it broke the previous trend and is now bullish. If you see it red, it means it broke the previous bullish run and went down. It went back green, means it broke the bullish candle and is now back in an uptrend. So by using this and using this wisely, this can also help you identify line breaks and trend breaks inside of the market as well. All right. Now, with that being said, let's go back over to the typical candles and let's come back over to our charts. Now, please remember that candles not only play an important role to understanding price movement, but the type of candle chart used by a trader can define their trading strategy and entry points. And that's because as you begin to change candlesticks, it incorporates different type of readings, which allows you to understand the market in a different way, helping to give you earlier entries, perhaps later entries, perhaps more confirmed entries. Maybe it can signal fake outs to you inside of the market. It all is really up to your imagination and your ability to put strategies together. So just keep this in mind that as one of the I Am Mastery Academy educators is presenting to you a trading strategy, these trading strategies may be based on one of these type of candlestick charts, and it will be important to incorporate the candlestick chart in the strategy that you're using if it's deemed necessary. All right. But as you guys begin to develop your skills as a trader, you guys can use any candlesticks that you want. Now, moving forward, let's talk about understanding the candlestick body. We're going to be sticking to the regular candlestick, as this gives you all the information that you need, which is the most important. So let's look at levels of bullishness and levels of bearishness. Now, as the market begins to trend, moving upwards, moving downwards, and moving sideways, you're always going to see a series of green candles, or you're going to see a series of red candles, as you can see here on the screen. Prices overall moving in an uptrend or a downtrend, or uptrend or downtrend. Now, regardless of the trend the market is moving in and making, candles are going to always be green or red. And that's because the price fluctuation is always going up or it's always going down. So when you're looking at these candles, again, as the alphabet of the market, you can incorporate your knowledge of candlesticks to help you understand the sentiment of the market, how the market is feeling, where the market is going, and also helping you with your entries. So levels of bullishness are like this. You'll see about, on average, 5 different type of candles with different type of variations. So you have the very first candle, which is the most bullish candle, which is a Marlborozo. I always forget how to pronounce that, right? So we have the marble candle, and this candle over here has no wick at the top or the bottom. It's simply a solid candle moving in one direction, basically opening and closing at the high and the low, showing an extreme price, showing like an extreme price movement or extreme buying pressure in the market. The second most type of bullish candle is something known as the hammer. So the hammer is where you have the candle closing bullish, no wick atop, and a long wick at the bottom. This is representing that price attempted to push down, but it did not have the ability to hold and close. The sellers were exhausted, and the buying pressure is more towards the upside. Now, please keep in mind that these type of candles, you can also use these as candlestick confirmations depending on the location of the market, right? So just bear with me as we get through this understanding. So that's the second most type of bullish candle if seen within a trend. The third type of candle is a normal candle. That's a candle that has a body with a wick above and a wick below, giving you a price reading. The next type of candle is a neutral candle, which is something known as a doji candle. This doji candle is simply representing indecision in the market, saying, I don't know if I want to go up, I don't know if I want to go down. But if you're in an uptrend and the doji closes a little bit higher and it is green, then it's more in favor of being bullish. And now the least bullish candle is the inverted hammer. The inverted hammer is in fact closing bullish, but we can see that there was a lot of exhausted buyers. Buyers tried to push this to the top. One more, try to push it to the top. Price could not hold it. Price came down, closed, and there's no wick at the bottom, showing that there could be, some selling pressure that's forming, but it ultimately closed bullish over here. All right. And the same is as true with levels of bearish. All right. So you have the bearish Marlborozo candle, or I like to call the marble candle. You have the shooting star, the normal candle, the bearish doji, and then the hanging man. All right. So these are going to be the 5 type of candles that you'll commonly see within an uptrend or within a downtrend. And this is what it's signifying to you in the market. Now, obviously, you most definitely want to go for the first two, especially in uptrending, or the first two, especially in the downtrending, if you want to understand if that trend is still very strong. Now, moving forward, let's talk about understanding the candlestick dojis. There are on average 4 different type of doji candlesticks. So let's talk about this. All of which, pardon me, let's read this here, right? There are 4 type of doji candlesticks, all of which have bullish and bearish implications. This depends on whether the doji is found in an uptrend or if the doji is found in a downtrend. So again, the doji is basically where the price is opening and closing right around that same area. Now, the doji can be flat, where it has no price color and it's black, or they could be very small dojis that are bullish and very small dojis that are bearish. These more so are known as like spinning tops, I guess you could say, and spinning bottoms inside of the market. Okay, so now when we talk about the variations of dojis, this is going to mean that there is a flat bar, price opened and closed at the same level, and there is no color to the candle. Okay, so the common doji again is a neutral candle suggesting the tie between the bulls and the bears. Now, again, depending, which remember what it says, this depends on whether the doji is found in an uptrend or a downtrend. So finding these dojis in the middle of a trend can signify something like the strength of the trend or the weakening of the trend. However, identifying these dojis at the top or the bottom of a trend, basically where you're looking for the market to reverse, can be one of your first indications that you can enter here as the market will in fact turn around. So if you find the regular doji at the top or the low, at the high or the low of a move, this could be a sign that there's a possible trend reversal. Now you have something known as the gravestone doji. This is a bearish doji, which means, it's more bearish, obviously, because price could not hold. You see the high cannot hold, and it ended up closing extremely low. So this is a bearish doji. However, this is also a good reversal indication in an overextended uptrend, right? Meaning that if you are all the way at the top of a trend and you see a gravestone doji, this could be the first sign that the trend has peaked and the market's going to turn over. And here is the counterpart, which is the dragonfly doji. The dragonfly doji is a bullish doji, right? Which means that if it's in the market, the sellers cannot hold the low and the price was pushing up. So if you see this within a trend, it could be a sign that the market wants to continue pushing up. Now, however, this is also a good reversal indicator in an oversold bearish market. So at the very, very, very end of a downtrend, if you see a dragonfly doji, this could signify that the market has had a peak low and the market will start turning over and going up as well. And then you have something known as the long-legged doji. The long-legged doji is basically the same as a regular doji. It just has a longer wick on the top and the bottom. So it's a variation of a doji. And this is just suggesting dramatic price fluctuation. So there is a big battle of buyers and sellers in the market. And you can also use this as a possible reversal indication at the high and at the low of a particular trend. Now, before we get into understanding types of candlestick patterns, what we're going to do is we're going to just attempt to identify some of these candles in the market so we can see what they look like. All right. So let's see if we can find these specific type of candles in the market at the highs, at the lows, and see if the theory is holding true. So we're going to stick to the USD Chef as we were on here yesterday. And what we'll do is let's go down to maybe a 5 or a 15-minute time frame, only because it may give us the option, the ability to see even more candles. As we know, price is always repeating itself on on all time frames. Okay, so as an example, let's see here. Now, if we look down here, what do we have? We can see that we have basically like some long-legged dojis right down here. You see how the market was coming down. We have a nice long-legged doji signaling the possible reversal, and then we're getting a nice little pullback over there. Now, let's see. If we come over here, we can also see that there is another doji right over here. Very, very, very good indication, okay, that we are at the top of a move and that the price may in fact turn around. Now, if we look right over here, we have a bear marble candle. Remember that marble candle? I can never pronounce this. So I'm just going to call it the marble candle, right? Take a look at the marble candle. We have it's bearish. No wick at the top, no wick at the bottom, suggesting that there's a lot of selling pressure. And look at how when price returned right back to the high, this selling pressure triggered a longer downtrend in the market. And as we can see, lots of different candles. Look, we have another doji candle, right? But closing on the bearish side, representing indecision. Is this going to keep going back up? But it favored the bears. It came down. We have a typical candle, a typical candle. Now look at what we have over here, right? We have another type of hammer candle, more dojis, and more type of candles. So as we look around, we can be here for quite some time, just really looking at different type of candles inside of the markets. But these are all here. I just want to see if I can find any other valid doji candles for you inside of the market. You see, we have another small doji candle right over here. Let's look at highs or lows of the moves. Okay. So we could be here all day. So we'll just go ahead and move forward. I believe that you guys get the point of understanding these candlestick bodies and these candlestick dojis within the market. So with that being said, let's progress and let's talk about more complex candles. We're going to start off with single candle patterns. All righty. So there are dozens. And when I say dozens, I mean that there are dozens. Okay. There are dozens of candlestick, single, double, and triple candlestick patterns within the market. A single pattern means it's one candle. A double pattern means it's a combination of two candles, and a triple pattern means that it's a combination of three candles that forms the candlestick pattern. Now, while there are dozens of variations of candlestick patterns, I'm only going to show you guys the signal strength of strong and very strong candlestick patterns. So that way you don't get caught in the world of just looking for every single candlestick pattern. So let's just look at strong and very strong candlestick patterns. Let's see what they mean. And we'll just do a quick action summary of each of the candles. So the first candlestick pattern is basically the hammer, right? The hammer candlestick pattern. Remember, the hammer candlestick pattern is in fact a bullish candlestick pattern, and found at the bottom of the trend. This can indicate a price reversal. So the hammer pattern can be found at the bottom of the trend. They usually give a signal that the downtrend has become exhausted. No more sellers are in the market, and the buyers can come in and bring the price higher. So a quick action summary. Where is the hammer usually found? It's usually found at the end of a downtrend. It's a single candlestick pattern. It generates a reversal signal, and it's a very, very strong sign that the market may very well, in fact, turn around. So the bullish variation is called the hammer. Now, if you flip it around and the price is going up and then coming down, the inverted one, or the opposite of this, would be the bearish version, is the shooting star. So if it's at the bottom of the trend, it's called the hammer. If it's at the top of the trend, looking the same exact way. That is called a shooting star. Let's see if we can find a hammer or a shooting star inside of the market at any of these specific reversal points. And bingo, here goes one right over here. Alrighty. Now, because this is the bullish version, this is in fact called the hammer. So as we can see right here, we have the hammer candle. The market was trending down. We had a hammer candle. Price began to push up. Price really stood above this zone. And as we can see, price began to give us a nice run up in the market right after that hammer candle was formed. So very, very good candlestick pattern. Now, moving forward, you have the inverted hammer. Now, again, let's take a look. The hammer and the inverted hammer. The hammer and the inverted hammer. So it's the same exact thing. The only difference is that the wick is on the opposite side. For a hammer, the wick is at the bottom. For an inverted hammer, the wick is at the top. So it's basically upside down. Okay, so if we flip that candle upside down, that would be considered an inverted hammer inside of the market. Okay, now as we can see, look at the inverted hammer right over here. We can see right here, again, it's not a big move because it's only the 5-minute time frame, but look how price began to push up, giving us an, oh no, that's not an inverted, wait, give me 1 second. No, sorry, that's not an inverted, pardon me. That is a regular hammer at the opposite side of the market, which is considered a, you have the morning star, the shooting star. These terminologies get so complex, and my computer is lagging again. So that is terrible. And guys, just so you guys know, I believe the only reason my computer is lagging is, just a side note here, is I updated my screens. I always had 3 monitors, but my mother and my stepfather actually gifted me with a curved monitor. And the curved monitor, the CPU and the RAM of the performance of this thing, because it's designed for gaming, is next level. So it sucks up a lot of the computer power. And I notice whenever I disconnect it, my computer runs a lot faster, which is still strange because this is a top-end computer. So just gonna have to figure it out. All right. Anyway, for the preservation of time, let's just move forward because we have a lot to go through. So we have the inverted hammer, which is found at the bottom of a trend, and it can signal the price reversal. And the bearish version of an inverted hammer would be called a hangman. Again, this is a pattern candle of just one single candle. It generates a reversal signal, and it gives you a very, very strong sign that the market can reverse, especially identifying this at price reversal zones. Now we also have different type of candles. This is more single candles, but this is a single candle, but it requires 2 candles together to form the pattern. So now we're moving into 2 candlestick patterns. This is known as a bullish engulfing candle. Now I just noticed that I never changed the I never changed the definition over here. So anyway, a bullish engulfing pattern. So don't mind what it's over here, okay? But a bullish engulfing candlestick pattern can be identified at the bottom of a trend, at the top of a trend, or anywhere it can appear at any point in between the trend. And this is representing that buyers, and this in a buy example, that buyers have completely overtaken the sellers in that specific period of time, giving us a very strong sign that the market may in fact continue in this direction. The engulfing candlestick pattern is arguably the most used and known candlestick pattern in the world. So we love to trade bullish and bearish engulfing candlestick patterns, and many strategies are actually based around the bullish and the bearish engulfing patterns. So amazing, amazing, amazing pattern that you guys want to pay attention to. The bearish version of the engulfing candle is simply known as the bearish engulfing candle. Now, moving forward, we have the next type of candle, which is known as the bullish or the bearish harami. Now, the harami in Japanese term means pregnant, right? So when you're pregnant, you have a baby inside of you. So this is basically saying that the candle is completely inside the previous candle. So a simple term, or if you guys don't like the bullish or the bearish harami, another very, very popular or simplified name for this candle is known as the inside bar. Okay, so some people call it an inside bar, some people call it a harami. It just depends on what you want to call it. Now, if you take a look at the previous look over here, you can see that the bullish engulfing going up was completely larger than the previous candle. From the body to the wick, it is completely larger, completely overtaking the previous candle. That's a bullish engulfing. Whereas you look at the harami is the inverse of the bullish engulfing. This is actually where the entire candle, the body, and the wick is within the entire previous candle. Many people don't trade the harami or are not aware of the harami because you have to use your eyes a little bit more to signify this. But once you see this, these haramis or these inside bars are just as powerful as bullish and bearish engulfings. So let's move forward and let's talk about it. This candlestick pattern appears quite frequent and can be found during a trend or as a continuation pattern. But they have a much higher chance of success when they are seen at the bottom or the top of the trend. So this is a 2 candlestick pattern. It generates a reversal mainly, and it has a very strong signal strength. The bearish version of a bullish harami would be a bearish harami, or bullish inside bar, bearish inside bar. Now, moving forward, we're going to talk about the next one, and this starts to go into 3 candle patterns, right? Which means that you need to see 3 consecutive candles together form this pattern. This is known as a morning star. It has a doji inside of it. So this is known as a morning star in a bullish example, or in a bearish version, it's known as a evening star. So just think about at the bottom of the trend. At the bottom of the trend, what does the sun do? The sun goes up. So it's a morning, the sun rises. Look at the bearish as the evening doji. So if you're at the top of a trend, what does the sun do? The sun sets and begins to come down, hence evening. So morning star or the evening star pattern. This is a 3 candlestick pattern that can be easily overlooked, but gives you lots of information based on the shift in power between buyers and between sellers. Now, this is normally found at the end of a trend, downtrend or uptrend. It generates a reversal signal, and the signal strength is very strong. So just keeping in mind the bullish, let's say the bullish morning star is where you have a bearish candle followed by a doji, followed by a bullish candle. And the bullish candle is closing above the bearish candle. So that's very, very important to know. Many traders will look at the morning or the evening star as closing at an equal price, which you can do, but ideally you want to see the bullish candle close above the bearish candle. Okay, this is going to give us a very, very strong shift in power within the market. All right, now moving forward, I have this thing mixed up. We're going to go back into 2 candle patterns. All righty, now this is known as a tweezer top or a tweezer bottom. Again, at the bottom of the move, it's known as a tweezer bottom. At the top of the move, it's known as a tweezer top. I like to use tweezer tops and tweezer bottoms because they are very strong reversal indications that are extremely easy to spot. This is basically two consecutive type of doji candles that are forming next to each other. Okay, so where can it be usually found? At the end of a downtrend, but it can appear at any point. However, it does reduce its effectiveness. So if you're seeing this within the middle of the trend, ideally that's not what you're looking for. You want to find the low or the high of the move where you're looking for that reversal. And these are the candlestick patterns that you want to find to help you trigger those entries. Okay, tweezer top and tweezer bottom. Now, moving forward, we're going to end it off with this candlestick pattern. This goes into a 4 candlestick pattern. Now, there are not many 4 candlestick patterns that are as strong as this one. This is known as the 3-line strike. Okay, ladies and gentlemen, you have a bullish 3-line strike and you have a bearish 3-line strike. So let's talk about this. Not a common candlestick pattern, but this is one of the best. It's the only reason for its unpopularity is that it doesn't appear too frequent. Thus, people lose their interest in hunting for it. However, the 3-line strike is one of the best reversal indications. So again, quick action summary. This is found at the end or the beginning of a trend. It takes 4 candlesticks to be able to identify this pattern. And the signal strength of this is very strong. Now, a 3-line strike is as simple as seeing 1, 2, 3 consecutive bearish candles. And now, remember when we talked about that bullish engulfing candle? The bullish engulfing candle doesn't just engulf the first candle, doesn't just completely engulf the first candle. The 3-line strike is where the bullish engulfing engulfs all of the 3 previous candles. And it closes above the high of the of the first of the 3 candles, right? So as you can see right over here, when you find something like this, ladies and gentlemen, you can ensure that this will be a great area to enter in the market as the market will continue to push in your direction. So these are some of the most popular candlestick patterns, some of the most reliable candlestick patterns that you can use in the market when you want to enter. Remember, the reason why we're diving deep into candlesticks is because in the price action world, we're talking about support, resistance, supply and demand trends, price reversals, Fibonacci levels, X, Y, and Z. And at these levels, you need to see these candlestick patterns forming to give you the very first indication that the market will stop and reverse at those levels. Now, candlestick patterns can be found on every single time frame, from the 1 minute all the way up to the monthly. So it really depends on how you're analyzing your market and what time frame you're analyzing your market. Now, moving forward, I'm going to start giving you guys some candlestick trading hacks. This is where we're going to begin jumping back over to the market, and we're going to start looking at some examples, right? So here's a candlestick, trading hack. By successfully identifying a candlestick pattern on a higher time frame, which may suggest a reverse in the current trend, traders may reduce the time frame to identify ideal pullback levels to enter the market in the new direction of the trend. Now, I don't know if this is something that's widely popular, but this is something that I discovered and it really works out flawless. So we're going to start providing some examples right now. So let's take a look here before we come over to the live market. So let's say we were looking at a daily 3-line strike pattern, right? Or a 4-hour, but in this example, daily. Let's say we found a daily 3-line strike pattern. We'll see the series of 1, 2, 3 negative candles. We'll see the extremely strong bullish engulfing, which closes past the candle, giving us a 3-line strike. Now, right when this candle closes, you can reduce the time frame, let's say to an hourly or a 15-minute, whatever it is that you want to do. Or in this example, let's say a 1-hour time frame. You can reduce it to a 1-hour time frame, and you can watch the candles begin to pull back and helping you find an ideal price reversal level before continuing up. So ideally, you want to find, let me see if it's here. Okay, not here. So ideally, you want to find these pullback levels come to one of your key retracement levels, which is that 1/3 to 2/3 of a move pullback, which is that 38.2, that 50, or that 61.8 Fibonacci level. So let's take a look at the market and see where we can find candlesticks on a high time frame and then reduce the candlesticks on a lower time frame to find that pullback. Again, because the market is continuing to impulse and pull back, impulse and pull back, impulse and pull back as it's trending its way from zone to zone to zone. So let's come over to the market. Let's ramp up this time frame over to, let's just go to the daily, since that's the example that we're using for. Let's get extreme. This is going to be great for you guys to learn things like this. Okay. So we're going to go to USD Chef and let's take a look over here. All right. So what I'm going to do right now is I'm going to look for candlestick patterns. Okay. So let's see over here. Okay, we have a daily bearish engulfing candlestick right over here. Okay, so we're going to analyze that. We also have another very strong bearish engulfing candle happening right over here. We're going to take a look at that. We also have, let's see, we have a very strong bullish engulfing candle right over here. We're going to take a look at that. We have, let's see. Okay, let's just try to keep some other ones. We have another bearish type of engulfing candle happening right over here. Okay, we have another, let's come over here. We have another bearish engulfing happening over here. Man, this is getting good. Okay, let's see. Let me try to find different candlestick patterns inside of the market. You have like a variation of tweezer tops happening right over here. This is just a lot bigger. Let's see over here. Okay, we have another candlestick pattern right over here, right? This is the morning star, right? Where we have the bearish candle followed by the doji, followed by a bullish candle that is closing above the bear candle over there. Okay. Lots of candles. Now, again, we're just looking at reversal zones. Let me see if I can find other candles on here on the daily. Okay, so we have lots of engulfings. We have the morning star. Let's try to find different type of candlestick patterns quickly before we do this. With we're not including dojis at the top or the bottom. We're simply looking for 2, 3, or 4 candlestick pattern variations. Okay, let's come over here. Let me see. I am looking. Okay, let me see. 1, 2, 3. Wow, look at this. Here goes a daily 3-line strike right over here. Bingo. There goes a daily 3-line strike closing above that candle over there. That's fantastic. All righty. So we have good variations of different type of candles. So this is all on the daily. And again, I'm specifically looking for, right? I'm specifically looking for, like as seen here, I'm specifically looking for swing points inside of the market where trades are stopping and reversing. Now, again, while it is easy to identify these swing points because they have already happened in the market, remember, as you're using these prices moving along in the future, let's move over here. You're going to notice that these stop and reversal levels are going to be at some type of support and resistance levels inside of the market. So as you continue to get better with your price action and your technical analysis, and you're identifying your swing points, these are going to be the areas where you're looking for candlestick patterns to happen. So again, we're using daily candlesticks. Now let's jump down to the 1 hour, and then let's look for our pullback candlestick hack. Okay. Now this right over here, this was the daily bullish engulfing candle. Let's take a look at the Fibonacci. We're going to do from the Fibonacci high to the Fibonacci low. We're going to do high to the low of the candle. Let me adjust my Fibonacci's. Okay. Now, before we get into Fibonacci's again, the reason why we're using this tool is because a typical pullback is 1/3 to 2/3 of a zone before price continues in that direction. So I've already labeled my Fibonacci. So you'll see the black line is between the 38, the 50, and the 618, which means that if price pulls back anywhere within this area, that's a valid pullback level. Okay, so now if we take a look over here, what happened? Daily candle closed, candle ended up retracing, came right back to a pullback level. And if you entered successfully in that trade, you would have already been over 40 pips in profit, right? Let's take a look at this other price reversal candle over here. Now, as we can see over here, this one actually gave us a 100% candle pullback. So if I put the Fibonacci's and I go high to low, again, what is the factor variation? Well, again, it's using time, it's using price action within your time frame. Meaning, look at how I'm using the low to create a support and resistance level, and I'm lining up that low with a Fibonacci level, right? So same thing we did on the daily, we're doing it on a smaller time frame. So on the daily, right? Let me draw this out because I don't want nobody to be confused. Okay. So on the daily, let's say you're looking for a resistance on the daily, boom. Let's say price hits the resistance on a daily and then gives you a candlestick pattern. Bingo. Now you're simply zooming in, right? You're simply zooming in on that candle, this is the daily bearish engulfing. And now the pullback, right? The pullback level, you're also looking for the pullback level to come to some type of support or resistance within these price reversal zones. And then ideally identifying more candlestick patterns. Like, look here, now you have a 1 hour bearish engulfing candle at a price reversal zone, while the daily had a bearish engulfing candle at a price reversal zone. So you see how we're using multiple levels of time frames for this candlestick hack? It's very, very good. Now, in the event that you do not understand what I'm saying, as you rewatch this boot camp and you re-study what I'm saying, this is going to make absolute sense because I cannot explain it any easier. Okay. Now, as we can see over here, this one had a low. It gave us the ability to potentially sell off at that 50% level. That one didn't hold. Price pulled back up 100% of the high before dropping off. So that would have put you in a solid 30 pip drawdown before giving you, over 90, 100 pips in profit. Okay. So let's move forward. Let's take a look at some other strong candles and pullbacks in the market. Now let's try to do this swiftly without TradingView freezing on us today. All right, ladies and gentlemen, give me one moment. Let me adjust my seat, guys. All right, let's come down here. Bingo, here goes the next bullish engulfing candle. I'm going to use my Fibonacci from the low of that candle to the high of the candle. And again, I am simply looking for the pullback of that candle at a beautiful support and resistance price reversal zone. Bingo, I found it. Yahtzee, that price took off. That is insane, right? If you guys are watching the live stream, drop a fire emoji for me inside of the chat box if this is making sense to you. Okay, let's come on. Let's take a look at the other candles that we have identified on the daily. As this market loads, let me see, do we have something up here? Bingo, here goes. Here's another daily. Okay, there goes another daily price reversal candle. What are we doing? We're taking the high to the low of the candle. We're waiting for the pullback. Pullback comes within our price reversal zone. One more time, right at these price reversal support and resistance levels. Another bearish engulfing. Bingo, price takes off. Look at how amazing that is right over there. All right, let's keep it moving. Let's keep it moving. Let's keep it moving. Here goes another example. Okay, let's see. Here goes a bearish. This was, I believe this was the other bearish engulfing daily candle. The daily candle closed, right? The daily candle closed, and the daily candle closed, the bearish engulfing on the daily closed. We reduced the time frame to the 1 hour. We watched the market pull back up on the hourly, and all we're looking for is for the market to come to some type of price reversal, pullback, and then continue in the direction. Bingo, there goes another valid trade idea right over here. You guys are going to be wizards in the market with this, telling you. And again, you could do this on all time frames, right? Here goes the other candles. Here goes the other candles right over here. There we go. Another pullback. Candle closes, opens up. I mean, I cannot make this up. Look at this. Bingo. There we go. One more time. Bearish engulfing. Price gets to going. Okay. Now we can see with this one over here, this candle from high to low actually did not whatsoever give us any type of pullback over here. So, you know, it did not hold in this area. The market just kept going. But if you get a little good with your price action and you're still looking for your swing points, you can see the market going back into market structure rules. The market broke the previous high, setting a new high. Market giving us a retracement, a counter trend, giving us a pullback to a standard breakout level at a 50%. And this market did go up. The combination of indications was the daily bullish engulfing here with the break and retest. So that is also valid. All right, let's keep it moving. I want to just simply go to that 3-line strike. I want to see where that was at. This right here was the, as we can see over here, this was that morning star. Remember, we had the bear candle, we had the doji, and we had the bullish. This was the morning star candle happening, evening star, pardon me. This was the morning star. Yes, price was starting to go up. If we take a look at this morning star, how much of a retracement did we get? We can kind of push a little bit higher. Still came within those zones. And look at how this 3-candle pattern ended up holding true for us, giving us a nice bullish run. Okay, now we're going to take a look at the very, very, very last. I want to see that 3-line strike. We're going to take a look at that 3-line strike, and then we're going to move on over here because we still have a lot to cover. We did want to spend and acclimate a good amount of time to candles because of how important they are, right? Many people are always looking for candlestick education, and I'm happily able to provide that to the IM community. All right, let's come over, and there we go. Here goes the 3-line strike. This was the very, very last candle that we'll look at. And one more time, even on 4 candlestick patterns, look at how that 3-line strike gave us a beautiful pullback from high to low, right in that zone. And bingo, ladies and gentlemen, beautiful level of support, nice market reversal, and the market goes up. All righty. So I believe that we have successfully proved our point for candlestick trading hacks. This is going to be something that you can use at a very, very high level. Now, moving forward, let's also talk about candlestick zone characteristics. This is extremely important. So identifying strong key levels in price, such as valid support and resistance, supply and demand, and or price reversal zones can become a lot more clear once a trader can successfully identify candlestick patterns at these previous price zones. So what do I mean? In our previous classes, we talked about, again, support and resistance, supply and demand, big candles, stop and reverses at these areas. Now, if you have price running back into an area of resistance or running back into an area of support, or maybe it's at a price reversal zone where you're getting hits on both sides of the designated structure level, identifying candlestick patterns at those structure levels can help you determine the strength of those zones. Is this a strong support and resistance? Is this a strong supply and demand? Because if they are, by identifying these candlestick zones, you can have more confidence coming and trading off of that zone, right? So remember, traders can use new or current price reversal candles to their advantage, serving as a confirmation to enter within the market. So one more time, I believe I'm repetitive. Market came to a point of resistance or a area of, let's say, supply. We had a bearish engulfing and the price pushed away from that zone. The bearish engulfing at that zone is giving us a sign of liquidity in the market. The volatility rate and the speed in which it left that zone is also letting us know that's a very strong area. Price comes back to that area, and now you're saying, hey, should I sell here? Or is this going to break through and keep going up? Well, now you identify a reversal candle, and if you get a reversal candle in combination with your price action analysis, that can serve as an entry point and confirmation to continue taking the trade in the direction of the market, right? Example, okay? Example. Let's come back to current price. All right, let's come back to current price levels just so we can keep this more related. We're way too far back. Okay. All righty. Let's remove all drawing tools from this chart right over here. Okay. So let's say I wanted to find, we can use this level of price. Give me 1 second. And again, I can't successfully see the candles, but we're going to use this example. Okay. And we're going to put the price line right over here. Okay. So remember, identifying this level here. Identifying this level here. Remember, we spoke about how this zone was a price reversal zone, as we had price rejection on one side and we had price rejection on the other side. So when price returns to this area, this serves as a valid structure area, which is what we call a price reversal zone. And in terms of a Fibonacci retracement, it also did give us a valid Fibonacci retracement of 50% at that particular zone. Now, another way that we can verify that this is a strong zone is by looking at the candlestick zone characteristics. Meaning that when we look at the zone, do we see candlestick patterns at these areas? I see an evening star pattern happening over here, bullish engulfing right over there, very, very long hanging man. Look, bullish engulfing at that zone. As we're coming over here, we see bullish engulfing breaking through. We see bullish engulfings pushing the market up. When price was below that zone, what do we see? Bearish engulfing below the zone. Bearish engulfing below the zone. Okay? This is simply price just breaking through. And I'm trying to move. Okay, there we go. And then that was the start and the end. So again, just because there's a lot of lag, I don't want to get too crazy. This is helping us identify, this level in price. This is called a candlestick zone characteristic. So when you're looking for support and resistance, supply and demand, simply identify if they were previous candlestick patterns at these zones, letting you know that there was valid price rejection to strengthen your support and resistance zones in the market. Okay. Now, if anybody is not understanding, simply speaking to the live viewers here, it's very important that you have watched all 4 of the previous FRX Beginners Bootcamp to even understand the terminology, because we are pretty deep into this training. And any terms that I am using are terms that I have already introduced to you in the previous training, which means that you're going to have to go back to the previous trainings and watch those, take notes on them, understand what I'm saying. And as we're moving forward, this is going to be crystal clear to you. All right. Now, moving forward, let's begin to jump into the world of Fibonacci's. All right. Now, this is going to be a lot of fun. As we have been talking about price reversal levels, supports, resistance, price action, so on and so forth. Another common theme that we have been talking about are the pullback and retracement levels. How once a market gives us a impulse, once the market gives us a bullish run, the market will pull back or give us a retracement. And that pullback or retracement is on average 1/3 to 2/3 of the run before continuing in its trend. Okay. And you guys have seen that I have been using my Fibonacci tool quite frequently. Well, now you guys are ready to actually discover and learn what the Fibonacci is. All right. Now, this is going to be basic Fibonacci training, as there are a lot of advanced concepts and teachings and styles simply based on the Fibonacci. So let's get right into it. So what is Fibonacci? Forex traders use Fibonacci retracements to pinpoint where to place orders for market entries, take profit levels, and stop loss levels. So you can use the fibs for entries, take profits, and stop losses. Very important. Fibonacci levels are commonly used in Forex trading to identify and trade off support and resistance levels. So when using support and resistance, guys, when using supply and demand, not only can you identify support and resistance by the candlestick patterns that are happening at these zones, not only can you identify support and resistance if it's exhibiting price reversal, features, right? But you can also validate support and resistance levels by combining them with Fibonacci levels. This will strengthen your zones inside of the market. And these are honestly the 3 most important, these are the 3 most important concepts of identifying, verifying, and solidifying the strength. Oh, I like that. Identifying, verifying, and solidifying the strength of a particular structure level inside of the market. Okay. So the use of Fibonacci levels in trading is perhaps one of the best examples of the core philosophy of technical analysis and the belief of many that trading decisions can purely be made from studying the charts without the need of fundamental analysis. Because again, many traders, going back to our previous masterclass, many traders believe that you need an economic outlook to determine where the market is going. So traders like to see the market watch, the economic forecast, the strength of a currency, to see where they believe that, where they believe that the banks are going to push the market. And then they're trading in accordance to where the market. So if the banks say, hey, listen, this currency, the DXY is strong, so we're going to be seeing a drop in GU, and then now we're going to be just selling off on GU because the DXY is going up, right? That's what we typically do. But there is a very, very strong argument in the world of Forex trading, and it's not simply based on theory. It's actually based on years of historic price models, sequences, and win ratios, because there are hedge funds, there are professional traders, there are people all over the world that use the Fibonacci sequence to forecast what's happening in the market without even understanding a fundamental analysis. As an example, I was very, very late to the fundamental analysis. I am still not the best at trading fundamentals. But if you give me a chart and you give me the Fibonacci tool, I can do wave projections all day long, and I'm extremely accurate, by God's grace in the market, because we're tapped into the Fibonacci sequence. So let's get deeper. Fibonacci numbers, when used to measure price swings in the market, represent powerful levels to watch for potential reversals and are applied to technical analysis in two main studies: Fibonacci retracements and Fibonacci expansions, where the market is going to pull back to and where the market is going to go. That's basically what we use Fibonacci's for. Where's the market going to pull back to and where's the market going to go? That's simple. Where's it going to pull back? Where's it going to go in this never-ending sequence of the ever-flowing market? So let's dive a little bit deeper before we go into the Fibonacci tool, and then let's talk about what makes the Fibonacci tool so unique. And what makes it unique is something known as the golden ratio. So let's talk about this, right? There is a unique ratio that can be used to describe the proportions of everything from nature's smallest building blocks, such as atoms in our cells, to the most advanced patterns in the universe, like unimaginably large celestial bodies, such as planet Earth. Nature relies on this innate proportion to maintain balance. But the financial market also seems to confirm, that's spelled wrong, I apologize. But the financial market also seems to confirm this golden ratio, which is known as phi. So let's talk about the mathematics. Mathematicians, scientists, and naturalists have studied, have known about the golden ratio for centuries. Now, guys, the golden ratio, market geometry, back in sacred times in Greek mythology and things like that, was actually known as the mathematic of the gods. You were actually killed if you were taught teaching about the golden ratio for many, many reasons. Now, moving forward, it's derived, pardon me, hold on. It's derived from the Fibonacci sequence, named after the Italian founder Leonardo Fibonacci, whose birth was assumed around 1175 AD and died around 1250 AD, so about 75 years later. In the sequence, he found out that each number is simply the sum of two preceding numbers, meaning that if you add one plus, if you have one, it's one. If you have 1 plus 1, it equals 2. 2 plus 1 equals 3. 3 plus 2 equals 5. 5 plus 3 equals 8. 8 plus 5 equals 13. 13 plus 8 equals, moving forward. And this sequence continues on forever within the known universe. It's the only mathematical sequence that is actually everlasting. It doesn't stop. It will always give you a continual, accurate reading moving forward. Now, anyway, but this sequence is really not all that important. Rather, it's the essential part, right? Rather, the essential part is the quotient of the adjacent number that possesses an amazing proportion, roughly the 1618, or its inverse, the 618, right? And that's why you'll see traders talk about the 618 pullback and the 1618 extension. This proportion is known by many as the golden ratio, the golden mean, phi, or the divine proportion, among others. So why is this number so important? Well, almost everything has dimensional properties that adhere to the ratio of 1,618. So it seems to have a fundamental function for the building. So it seems to have a fundamental function for the building blocks of nature. So basically, before we go into the proof, okay, this golden ratio 618, 1618, right, is known as mathematical perfection. And it represents a divine proportion. It represents a divine balance that's not only in nature, but when applied to the market, it also holds true in the market. And really, nobody understands why. It's not like it was something that was invented. This was something that was discovered. And just getting a little deeper into this, remember that this entire universe, if you erase everything, goes back down to binary sequence. Everything is binary numbers, ones and twos. It's how we create letters. It's how we create sound. It's how atoms are created. Everything goes back down to binary sequence and numbers, which is why computers and the animations that you see on your screen all breaks down to numbers and how it creates all of this. I mean, it's so divine. It's so it really is beyond my understanding, to be quite honest. Okay. But it exists out there. And this golden ratio, this divine balance and proportion is represented in everything in life, and nobody knows why. So we simply adhere to it. So here's some proof, and you can look this up, right? Not only can you look this up, but you can look up the golden ratio for everything, and you'll see it's everywhere. So proof, right? The article said, don't believe it? Take honeybees. For example, if you divide the female bees by the male bees in any given hive, you will get a 1,618 ratio. Sunflowers, which have opposing spiral seeds, have a 1,618 ratio between the diameters of each ratio, right? The same ratio can also be seen in a relationship between different components throughout nature. Now, if you need something that you can easily measure, try measuring your shoulder, right? Your shoulder all the way down to your fingertips. And then divide this number by the length from your elbow to your fingertips. So basically, look at your shoulder all the way to your fingertips, and then look at your elbow all the way to your fingertips. That's going to be about a 618. Okay, it's going to be about a 618. It's going to be about 2/3 of your entire arm. Okay, or try measuring your head all the way down to your feet, and then divide that length by your belly button. So if you take your head all the way down to your feet, and then you go from your belly button down to your feet, that's going to be about 2/3, about that 618 of your entire body, right? These results are always going to be the same. So the golden ratio is seemingly unavoidable in nature. And this is why we apply it to the financial markets, right? So look, the article said, does this mean it works in finance? Well, actually, financial markets have the very same mathematical base as these natural phenomenon. So the golden ratio can be applied to finance and is currently being used by traders all around the world, ladies and gentlemen. So, I don't know if I can explain Fibonacci ratio any better than what I'm doing right now, but this is just basically where the golden ratio derives from. This is why we use the Fibonacci tool in the market, and the Fibonacci tool just always seems to work out in our favor. All right. So anyway, so let's begin getting deeper into the Fibonacci retracements. Okay, yes, Fibonacci is life, 1000% for those of you that are commenting in the chat box. Like, Fibonacci quite literally is life. Like, it's everything. Like, once you get good at Fibonacci work, I mean, I'm telling you, there are, like, as an example, there is, depending on the time that you're watching this FRX Bootcamp, there's going to be a time where we are opening an EFX package, which is equities, options, and futures. And we have somebody known as the Fibonacci Queen who is going to be trading with us. She trades equities, options, and futures. She has made tens of millions of dollars, arguably hundreds of millions of dollars over her career, she is renowned as one of the best traders in the world, and she only uses Fibonacci's. That's it. She simply uses Fibonacci's sequences and relationships. Okay. So anyway, let's go. And she's going to be working here in our company very shortly, if she's not already on the package, depending on the time that you're watching this. Now, anyway, let's move forward because we have a lot more to cover. So Fibonacci retracements. Fibonacci retracement is a method of technical analysis for determining support and resistance levels. These levels are based on Fibonacci numbers. Each level is associated with a percentage. This percentage is how much of a prior move, how much of a prior move of the price has retraced. Okay, so let's talk about the retracement level. So again, when you're looking at a swing low to a swing high, and the market begins to pull back, that pullback or that retracement, okay, can come to, and it's always going to come to one of these Fibonacci points. Now, if it comes to the 23% Fibonacci level, that's about 1/4% of the move. That is considered an extremely shallow pullback. It could be the result of a very, very strong trending market. Now you also have the 38.2, which is 1/3 of the move, 50%, which is half of the move, representing balance in the market, and 61.8, which is 2/3 of the move. And that is the 38, the 50, and the 618. That is the typical pullback ratio. If you rewind this broadcast and you look at the candlestick hacks, you'll notice that each and every single one, well, not each and every single one, but pretty much every single one has pulled back on average to one of these typical pullback levels. So this is really what you're looking for. You're looking for those levels in there. Now you also have a 78.6%, which is anywhere between 3/4 to 7/8 of the move. This is considered a very, very deep pullback in the market, and that could be for a variety of reasons. Okay, and then last but not least, you have 100%, which is the actual bottom. And this example just explains it wrong, but 100% is where the market pulls all the way back down to the initial start of the swing. So that's a 100% retracement. And according to our market structure rules, that could potentially jeopardize the strength of the trend and could give you the first sign that the market could be reversing, but doesn't necessarily mean that. Okay, so these are the retracement levels. Now, next you have Fibonacci extensions, right? So Fibonacci extensions is after the market pulls back. The extension is, where do you believe the market is going to extend to? Where is the market going to go? How far, how high is it going to go once the market is ready to make a move again? Okay, so Fibonacci extensions can be highly utilized in different trading strategies and trading styles. These extensions can validate critical future support and resistance levels, find the potential reversal point and trend reversal areas in the market. So very important. For this reason, traders utilize this tool to project their overall bias on a bull or bear trend. Now, I forgot to highlight this over here, but let me reiterate this, okay? Extension levels can validate crucial future support and resistance levels, meaning that once the market goes from 0 to 100 and then the market gives us a retracement and pulls back, you're looking for where the market will extend to. Now, if you see an extension level at a previous price zone, like if there are keyed structure levels lining up with one of these extension levels, this can signify to you that, hey, listen, this is a future support and resistance level. This is a future reversal level. This is a future trend reversal zone inside of the market. So watch out. Okay. So extension levels are like this. 100% extension is the previous high or low, meaning that when the market goes from low to high in this bullish example and pulls back down, the market can pull back up to the 100 level, meaning that it will simply go back to the high of the move. So it's technically not an extension, but the market does have to, if the market goes in that direction, that could usually be a trader's first take profit. Then you have the 138.2, the 150, and the 1618. Now, these are common extension levels, and they are the derivatives of the 38.2, the 50, and the 618. So just like how these are the typical pullback levels, the 138.2, the 150, and the 1618 are common extension levels inside of the market. Very important to pay attention to. Now, the 200 is also a very common Fibonacci extension, and this represents 100% of the move. Many of times, depending on your trading strategy or your trading range, a price can extend 100% of the move because there's always this symmetry that's cooking up in the market. So if the market was, let's say from zero to high, let's say that was 100 pips, then the extension can go to up to 200, which would be another 100 pips. Okay. And then you have the 2618, which is another derivative of the 618. And this is where traders are looking for an extended wave forecast, meaning like this is where they're like, if they're looking for the market to really go someplace, this is usually where they're looking for the market to go. So as an example, market will go from 0 to 100, pull back to the 618, pull back up to the 618, pull back down, give us another retracement, and then push all the way back up to the 2618. Okay, and then that's like the overall wave forecast that they're looking for inside of the market. All right, that's a fib extension. So now before we talk about fib clusters, let's come over here to the market and then let's talk about fib extensions and fib reversals in the market. So as an example, let's say this market is going to continue to come down. We can see from high to low over here that this market pulled back to about 50% of the market. Now, if I inverse this, let's reverse the fibs. Boom. Now, when we reverse the fibs, let me get the 138.2. Let's make this, let's make that blue. Pardon me. Okay, and let's get the 150 and make that blue as well. Give me 1 second here. All righty. All right, there we go. Now, if we can see, these red boxes are the pullback levels. So essentially what we're doing, depending on the direction of the trend. So if the trend is bearish, you take it from the high, the Fibonacci, you plot the Fibonacci from the high, and then you plot the Fibonacci to the low, like a slingshot. Where it pulls back to is the retracement. So this pulled back to the 50%. Now, as the market continues to push and breaks the low, this is now called an extension. So once that market breaks that low and continues to come, that's an extension in the market, right? And in terms of market structure, by breaking up the low, that's a sign that the market will continue in the direction. How far the direction will go can be interpreted by Fibonacci extension levels. So the derivative of 50 is 150, right? Or so to speak, in these areas. So traders will suspect that this market, if it breaks this low and continues to come down, that it's actually going to shoot around this area before price has a significant reversal in the market. So that's an extension and a retracement. Okay. Now, let's take a look at something else over here. So let's look at extensions and retracements, right? I'll give you another example because we are running short on time. Now let's look at extensions and retracements. Again, this market's going in a downtrend. Why is this market going in a downtrend? Well, let's see. You have the high of a zone. You have the low of a zone. and then the market broke out of the low of that zone, signaling to us that, hey, the market may want to, in fact, keep coming down. So now that the price broke out, you want to find, well, where is the price going to retrace or pull back to? Is it going to come back to this previous break in structure? Now you're going to take your Fibonacci's, because you see it's a bear market, from high, the start of the move, to the low, which is the breakout of the move. Okay, you're going to determine what the pullback ratio was right over here. And as you can see, let's say this is around 50% of the market. The market pushed down and the market came to the derivative, which is about 150 pip extension before we seen that next big reversal in the market. Bingo, right? Now let me give you since that's a bearish, let's give you a bullish. This is a good bullish example over here. There's dozens of bullish. I could use any bullish example. Let me see where price broke a previous high and then pulled back, right? Let's try to use something like this. Let's see if this ends up working. I believe this is more of a harmonic pattern, but we'll take a look at it anyway. So let's say here the market is going up, right? So we have a swing low and then we have a swing high over here, right? We can see that the market broke the previous high, right? So let's come over here. So again, the market was low, the market came high, the market started coming low, the market came high, the market came low. Again, we're still in an uptrend. Now, as the market begins to push up, what happened? It pushed up, breaking that previous high right over there. So we could say, okay, well, the market's now trying to continue in an uptrend. So eventually the market's going to have to pull back. So now that the market, I don't know why my dog is barking so much. So now that the market is pulling back, we're going to take the Fibonacci's from the low to the high, right over here. Okay. We're going to take it from the low. Oh my goodness, my dogs are bugging out. I'm so sorry, guys. Give me one. Okay. From low to high. So what do we see? The market pulls back, coming to a 38.2 pullback right over here. And then what is the derivative? Well, if the market's going to extend, it's going to extend up and it comes to the 138.2 above. Bingo. And then we see that next big retracement where the market ends up changing its trend direction. Okay. So this is how we use Fibonacci extensions and retracements in uptrends and in downtrends. There's no need to complicate it. Okay. Now, moving forward, there's something also known as Fibonacci clusters. Now, Fibonacci clusters is where you begin to get more advanced with your Fibonacci work. Okay. So a Fibonacci cluster is when multiple Fibonacci retracements or extension levels occur near one price area. Fibonacci clusters indicate that price could be Fibonacci clusters indicate that price could be an important support and resistance area or turning point. Traders may opt to enter or exit trades around Fibonacci clusters. So what am I saying? I'm saying that a Fibonacci cluster is where you're using the Fibonacci at two different levels and they're lining up at the same exact point at the market, giving you a Fibonacci cluster. This is giving you even more strength to key levels in your market. Okay. Now, Fibonacci, here are two Fibonacci cluster combinations. You can have any two Fibonacci, you can have any two key Fibonacci retracement levels, meaning that you can see, let me come over here to the market. Let's remove these drawings. Let me try to really find something over here. Okay, let's use something like this. Okay, let's say I'm using these swing points. So I'm going to use swing point 1 right there, and then I'm going to use the second swing point from here to here. And now I'm going to try to find both of them give me different key Fibonacci levels. So the first Fibonacci level, let me inverse this. Let's hold this here. Pardon me, just pardon the lag over here. Okay, so the very first Fibonacci pullback level from that swing point came around 50% of the move. Now, if I take, give me 1 second. We were doing good today. We don't want this to start lagging towards the end. So this first retracement came to about 50%. Now, if I move this, now if I use the second swing over here, we can see that this Fibonacci level, okay, so this wasn't such a valid, a valid one, but we can see that the second one gave us about a 618 pullback level right over there. So if we delete this now, we can see this is not the best example because this is creating a range, but we can see that between both of those swing points, we have a cluster of a 50% and a 618% happening at one level, suggesting to us that this can be a much stronger price reversal zone inside of the market. Now, ideally, while you can see these prices create a zone, you really want to see these price levels overlap. Overlapping them would give you a very key specific price level. All right. Now, you could also use a combination of any two extension levels inside of the market as well. So let's try to look for some extension levels inside of the market for some valid swings. Okay. We need to find more of a trending market. I mean, we could use something like this. I just don't think that this would be good because there is a long, strong candle there. So that kind of messes up the ratios a bit, but whatever. So let's say you look for the Fibonacci extension from here. We're going to do a Fibonacci extension from here. We're going to look at that pullback and look at the extension. And then we're going to do a second extension. Again, these are probably bad examples just for the preservation of time. And then we're going to do an second extension from here to here. Or we could do another extension from here to here. So 3 different extension levels. So let's try this out. So from high to low, market pulls back 618. These extension levels were right here. Let me try to line something up. I'm going to try to do this as fast as possible without confusing anybody. So this gave us 3 extension levels. This gave us this 31.8. Let's see here. This is a 150. And then we also have a 1618. Okay. Now let's change it. And then let's do the extension from this swing point. We could actually do extensions from all these swing points. Sheesh. Give me 1 second. Let's move this around. Oh goodness, come on. Okay. Now we'll do another extension of this particular swing point right here in the market from high to low. Let's move this back over. Stick with me, guys. All right, now if we look over here, we can see that these have a lot of similar extension levels. And this one right here really giving us a very, very strong overlapping extension level right over there as well. So we have two extensions. So we did one, we did two, and then let's do a full extension swing from the second low to the second high. Okay, and then you can see down here, this also gave us another overlapping extension down there. Right? So again, this is a poor example, but as you get better with your Fibonacci work, and this is not the class to become a master Fibonacci plotter. Pardon me. 1 second. Sorry about that. We had a little ad pop up on our Mozart. Now, anyway, coming back over here, you can use multiple swing points. Now, as we see at these multiple swing points, between using the Fibonacci 3 times in 3 different swings, there were 2 times that the Fibonacci's overlapped, and they were both right at these zones. Now I'm going to ask you guys, do you believe, let me come over here, do you believe that it's coincidence that these zones meshed together right down here, and this is where the market seemingly and perfectly popped right into these areas before turning around and giving us a bullish run? It did not. Now, if you look at this and we extend this back, remember, we talked about how extension levels can show you critical price reversal levels in the future or establish zones of support and resistance. Now, if you were trying to establish this low as a good level of support in the market, well, guess what we did? We just used our Fibonacci extensions, and we just seen that this zone right where that support was also our Fibonacci extensions. So you see, Fibonacci extensions and retracements can be absolutely powerful in the market. So you can combine 2 Fibonacci extensions, and now you can also combine a combination of Fibonacci extensions and Fibonacci retracements. Okay, and that's this example that you see here. A Fibonacci extension and a Fibonacci retracement at the same exact point in time is basically where if you're looking at from high to low, the market is pulling back to the 618. But as the market is uptrending, after this retracement, the extension is the 1618, giving us a key level of a Fibonacci extension at one single point. So the 618 and the 1618 met up at the same point in time. And I do believe that that happened over here on USD Chef. So let's take a look at this in real time, right? If we take a look at this in real time, we can take a look at the Fibonacci from the high to the low. And we can see here that the market came around that 50% level right over there. Now, if we look at the Fibonacci, let's look at the pullback right over there. You see that pullback? If you look at the Fibonacci pullback from this high to this low, right over here, after the market pulled back to the 618, look at how the market came right here to the 1618 as well on the extension. Pardon me for talking so slow. It's just that this trading view is moving slow again, and it's really refraining me from educating. Okay, boom. So now you have a Fibonacci retracement and you have a Fibonacci extension, both at the same exact area. If we bring this price out, look, we're at a beautiful structure level in the market. We're actually at a beautiful price reversal zone in the market. Hit on one side, hit on the other side, hit on the other side, and bingo. Look at that crazy drop off, guys. Okay. So now just remember that they're moving forward from the Fibonacci clusters. Fibonacci clusters can also derive from a combination of other Fibonacci tool key levels. So they're not just the Fibonacci. Fibonacci's are also comprised of Fibonacci retracement, Fibonacci time zones, Fibonacci arcs, and Fibonacci spirals. Okay, so arcs, spirals, time zones, and retracements are all different variations of Fibonacci that help you predict price retracements, extensions, and a hidden element in the market, which we're not going to be discussing throughout this price action and FRX Beginners Bootcamp, but there is a huge element of time in the market, which plays a huge factor in price changes. So you can use a combination of all of these Fibonacci tools if you wish to continue your journey with Fibonacci's that you can use together to create Fibonacci clusters. Now, remember that mathematical Fibonacci clusters may often, just moving forward because we got deep here, but mathematical Fibonacci clusters may often form variations of harmonic patterns that can be traded with price action. So we do not have harmonic patterns here, but if you look at one of our key, let's come over here. If you look at our harmonic pattern, I only have there we go. If you look at one of our flagship products, which is the harmonic scanner, I am the harmonic scanner master educator as well as the harmonic scanner pro master educator. But if you pull up the harmonic scanner, which is again one of IM's flagship products, the harmonic scanner creates scans. Remember, it's a price concept. We talked about in the beginning how there are a variety of price concepts that you can use with your technical analysis and price action trading that can allow you to understand the order flow of price. Harmonic patterns happens to be one of those price concepts. Now, if this amazing tool will load up in the market, we're going to do absolutely wonderful things here. So just give this just one moment. Slow is good. Yes, it is. You love the fact that I'm talking slow. Now, guys, if you're watching this pre-recording, I'm just digressing as this is loading up as my computer CPU is extremely high. So just give us a moment. Okay, at this point, I believe this is simply the website lagging. So let's see if we can get in. Waiting for harmonics. We're just waiting for the website to load. Give us 1 second, ladies and gentlemen. I hope you guys are finding an extreme amount of value in these FRX masterclasses. And while this is loading up, again, I just want to digress and let you guys know that please take this education extremely serious. Make sure that you guys have a pen, a paper, a notebook. You're taking notes on every single thing that we're writing down here. Back test, study, analyze until everything comes together. Okay, so there definitely was an issue with the actual harmonic scanner, not with the lag. So let me try to go up. Let's try to pull up the testing server. I do have a testing server. Let me try to pull up this testing server. Let me see if we can log into this testing server. All right, bingo. The testing server is up and working. And this testing server will also allow us to see the harmonic scanner. So as we come over here and we look between different brokers, let's get rid of this. Okay, let me just go to brokers that I like. We use FX Choice, whatever the case is. We could use Hugo's Way, whatever it is that we want. All right, now anyway, as we come over here looking at this flagship product, I'm going to try to find a large harmonic pattern. If this thing will load over here. And again, this harmonic pattern does look strange, but we're just going to stick to it over here. Okay. All right. Now, anyway, if you take a look at these harmonic patterns, you'll notice that X to A, which is the high to low, B is giving us a 618 retracement, while A to B pushing up is giving us about a 50% retracement, while B to C is giving us a 127 extension and X to A is giving us a 786 retracement. So what a harmonic pattern means is that Fibonacci clusters are where you're using a combination of two Fibonacci levels at one point to create a strong price reversal zone. But because these Fibonacci numbers have correlations and derivatives, harmonic patterns have been discovered where if certain markets retrace and extend in a very specific scenario, you can create highly predictable market trends by using this mathematical algorithm called a harmonic pattern, which is why the harmonic pattern is one of our company's most powerful tools, but it is also extremely overlooked for this specific reason. If the harmonic pattern gives you an entry and the entry does not trigger and the trade hits stop loss, traders begin to deem the harmonic scanner irrelevant. And the harmonic scanner is in fact not irrelevant. The only thing that's happening over here, as we're taking you through some of the losing trades that you can see over here, right? You see how each of these trades are losing. And I'm glad that this is showing right over here, is because when this is happening inside of the market, our members, our traders are saying, hey, listen, this thing don't work. It's always hitting stop loss. Remember this, the harmonic scanner is a strategy in the market. It is not a golden ticket to always let you know what's happening. Harmonic patterns can form out of randomness, meaning that if the market is just pushing down and pushing low and pushing down, like taking a dice and rolling it in the thing, you might land on a snake eyes. There's a chance that you can land on a snake eyes and then just get pulled out of that game of dice. Just like how, because the market is always pushing back and forth, the market can create harmonic patterns that are not meant to be created. So the purpose of the harmonic scanner is to identify harmonic patterns in the market. And our job is to simply use this as a tool, as a reference point, and say, hey, listen, is this a good harmonic pattern? Is this a good area to buy? Is this a good area to sell? Which is how I typically trade. I always open up the harmonic patterns. I look for potential buys and sells in the market, and then I confirm the buy or the sell with price action, technical analysis, or my strategy. And I use this as a tool, as a reference point to help me spot and identify potential trend reversals inside of the market. Okay, so just keep that in mind when it comes to using the harmonic pattern, the harmonic scanner. It's very it's a very good tool. You just have to know how to use it. All righty. Now, anyway, moving forward, and then the benefit that it will give you stop loss and take profit levels as well. Now, anyway, moving forward, talking about Fibonacci extensions and retracements and candles and coming off our previous zone, we're now going to jump into something known as market confluence. What is confluence? Confluence is going to help you as a trader, increase the probability or increase the odds of entering in the market. Remember how we talked about entries, how you have that E1, E2, and E3 entry? You're always looking for entry points in the market. Well, whenever you want to strengthen your entry points with multiple confirmations, that single point in the market is known as confluence. So as an example, confluence in Forex is a concept that allows Forex traders to combine variety of various technical analysis tools and instruments to judge whether any particular trade has a better or worse odds of success. So without going over to the market, let's just take a look at this example that I created over here, and let's look at a confluence checklist. So confluence checklist, let's say we wanted to buy up in the market right over here, right? We seen the market was coming up, coming down, pushing up, coming down right over here. And if we want to just buy, what are the reasons that we can buy in this market? Let's see if we can find confluence. Let's see if we can find various confirmations at one particular point in the market that can allow us to increase the odds of this trade. So in this one example, there are 6 different confluence confirmations. Confluence confirmation 1 is that price was creating new highs and new lows in the market, meaning the market was going low, high, low, right? So the market is now creating an uptrend in the market. There's also an order flow off the demand zone, meaning that as this market started uptrending over here, it was coming off of a big demand zone, letting us know that the market wants to push up for a longer period of time. 3, or trading off a support level, whatever is easier. 3, there was a break and retest to a PRZ zone. So let's say that we also seen a price reversal zone. Not only is it coming off of a key support, not only is it creating a series of higher highs and higher lows, but it's also giving us a break and retest to a previous structure and price reversal zone. In addition, there was also a Fibonacci retracement level. So we took our Fibonacci's from low to high, and we see at that same exact point, there was a 618 retracement, giving us an ideal reversal level in the market. In addition, the price may be also testing a trending MA. Remember, if you're not using trend lines, you can use MAs, EMAs, SMAs, McGinley's, or different variations. So this green line is representing an MA. So we could say that the market may also be pulling back to some type of MA in the market at the same point of time. And then last but not least, there could have also been a bullish engulfing candlestick pattern, all at that one specific price level in the market. By doing that, we now have 6 confirmations to enter the market. This helps us reduce our risk and states to us that price is more likely to move in favor of our technical analysis, ladies and gentlemen. Okay, that is confluence inside of the market. What you're seeing over here is confluence in the market over here, right? This is confluence. The market going from high, low, high, pulling back to a price reversal level. Let's see if there is maybe some type of trend line happening over here. Let me try to open that up. Okay, let me see what time frame this is on. Let me come to, let's say, a 4-hour. So 4, no, let's try a 30-minute. I'm just trying to finesse this thing over here. I might have to use something else. But let's say there was some type of, the MA was right up there as well. That could give you another confirmation, right? At that one area in price. Looking at the bearish engulfing candle, confirmations, confluence confirmations, ladies and gentlemen. All right, and as we dive deeper and we begin to go into recapping, you're going to learn a lot about confluence. You're going to see confluence a lot. Now, what we're supposed to do, ladies and gentlemen, is we are also supposed to be ending this class with the use of indicators. So because you guys have been here with us for the past 2 hours, and I am extremely impressed at your level of dedication to further your education in the market, I'm going to make this brief. All righty. Now, last but not least, let's talk about indicators in the market. Now, while indicators are not a part of price action, I do believe that indicators should be included in the FRX Beginners Bootcamp, because you are going to be introduced to a variety of different price indicators throughout your trading journey and career. And trading indicators are extremely, extremely, extremely alluring. You can gravitate to indicators because they can help you read and interpret price data. So let's talk about it. Forex indicators are one way of examining market data. By examining historical data such as currency price, volume, and market performance, among other things, the indicators seek to predict how the market will behave in the future and which patterns are likely to repeat. Okay, so there are 4 types of indicators. There are trending indicators, there are momentum indicators, there are volume indicators, and there are also volatility indicators. Now, while this is not going to be an indicator training, we are going to introduce these concepts to you. Trending indicators include things like the MACD or the awesome oscillator. This will let you know if a price is in an uptrend or a downtrend, depending if it's above or below the MACD, right? So let me see if I can start to just simply add. Let's come over here. Let's look at the awesome oscillator. Let's look for an EMA or a moving average. Okay, and then let's also look for a parabolic SAR. All right, we're going to get rid of the rest of these indicators right over here. Okay, now if we look over here again, these combination of indicators, let me just remove my drawing tools from this market here. These indicators here helped us detect the trend. So if price is below the MA, if price is below the parabolic SAR, and if price is below the baseline on these three indicators, this is signaling to us that price is in fact in a downtrend, ladies and gentlemen. So, and then if it switches above, if price goes above the MA, if price goes above the parabolic SAR, if price goes above the baseline, the bars are up, that would represent an uptrend. These are things that help us determine the overall trend in the market. Is it bullish or is it bearish? Now, we also have something known as momentum indicators. Now, the MACD can also help us, and the awesome can also help us understand momentum in the market. But there are also things such as RSI and the Stoch. So if we come over here and we add things like the stochastics and the RSI, let me see, Stoch, RSI, yeah, all the same thing. We can come to the RSI as well. Okay. And let me just change these colors because these colors are so dark, though they are depressing. All right. Okay, there we go. Now we also have momentum indicators. So these help us understand when the price is essentially oversold in a particular asset, pardon me, if a price is overbought in a particular asset, or if it's oversold in a particular asset. So this would help us understand if there has been a big stretch in price and if price wants to snap back down. And there's a wide variety of instruments that will allow you to understand overbought and oversold. The MACD and the awesome helps you understand the momentum by the bar colors above and below. So if the bar colors are green below, that means that there is buyer's momentum. If the bar colors are red above, that means there's seller's momentum. So traders will look to, use a combination of these different things. As we take a look over here on an hourly time frame, right? We can see here price was oversold. We can see here price was oversold, and it begins to turn up, gaining momentum. It turns up, gaining momentum. Bars turn green, gaining momentum, and then these bars begin to come up. So that's momentum-based indicators. Momentum-based indicators just represent the sheer amount of people that are jumping into the market at any given time. Okay. Volume indicators such as the money flow or session volume, and I would really recommend session volume as the best volume indicator. I really wouldn't use anything else if you guys want to trade with volume. Volume indicators basically tell you where all of the money is at in the market, okay? Where the most money is being traded at a specific point in the market. Volume helps you with the concept of breakout and retest. So anytime you're looking for the market to break and retest, you want it to basically break and retest to an area where there's a high level of volume. right? That high level of volume will let us know that there's a lot of money there, and that this is where we want to buy and sell. So as an example, if we take a look at a session, right? If we take a look at a session from high to low, right? The majority of the volume in this session, was right over here. And we can see that the price retraced back up there, and then it dropped off. Now we could see in this next session, the main volume, that red line, that point of control right over there, was right there. Now, when the volume retested, when the market retested, that ended up being a good area to enter because there was a high amount of volume, and then the market moved. Now, we look over here, same look. Here's the volume. Here's the session of the volume. There goes the red line. That was the majority of the volume. The price breaks out above and retests over here before continuing up. Okay, so this is essentially how you can use. The volume, and there's another one which I believe is the fixed range volume. Let me see over here. Is it the session volume, the visible volume? There we go, the visible volume. Now there's also something else over here called the visible volume. This visible volume over here, depending on where you're looking at on your chart, this will give you the overall point where the most money was being traded in a specific area in your market. You can also use this as well as active levels to trade inside of the market. Now, using volume profiles and things like this can be very advanced, but as you begin to get good with your price action, your technical analysis, things like this can also help you trade. And last but not least, you have volatility indicators such as the Bollinger Bands, the average, the ATR, the average two directional range, and things like the DMI, right? And things like the DMI. So let's come over here. Let's get rid of these things. And again, guys, I apologize for my dogs. They are going crazy over there, right? So we can get ready to wrap this up. So let's look at Bollinger Bands, and then let's look at something known as the DMI, right? Which is the directional moving index. These are things that we use, okay? This helps us determine volatility. One second here, let's get rid of this. Oh my goodness, 1 second, just trying to stop this lag. Woo, those dogs are going crazy. Okay, now anyway, we also have volatility. So volatility is basically like the rate in change of a market. So let's put this to like a much, much wider level. Let's set this maybe to like 50 or something like that. Okay, there we go. Now, whenever you see this, this is basically like an acting support and resistance, meaning that if the market pushes up and it hits a volatility, there is a good chance that the market is going to push back down. It hits the top, good chance it's going to push back down. Hits the bottom, good chance it's going to push back up. And if you look at the DMIs down here, let's see, let's adjust this to, let's say 5-1, and we come over here. We can put buyers, we can put sellers. Let me change this to 1 and 5, pardon me. Okay. I don't know where my black line is at, but anyway, now if we see this, again, this is the exchange in rate. What is the ability, what is the likelihood that the market is going to gain a lot of volatility and new money in the market? So we can see over here, once the price hit the Bollinger Band right up there, right? And then the sellers took control and there was a lot of sellers volatility in the market right at the same time. The market then dropped off inside of the market right over there, giving us a nice push in the market. Okay. So these are all different type of indicators. Your strategies, your price action, the way that you read price is I'm so sorry, guys. These dogs are so distracting. And I feel like each and every single one of these videos have one point or another where something is distracting me or something is messing up. Okay. But anyway, getting ready to wrap this up, guys. The use of indicators, again, is also very subjective. Please remember that price moves first and indicators move second. So indicators will never be more accurate than pure price reading, which is why you'll see that there are price action traders that only use price. But then again, you'll see that there are some indicator traders, right? Robotic traders that are using a combination of indicators to find ideal entries and exits inside of the market. You can use indicators to help you with your price action analysis, to give you multiple confirmations within the market. Alrighty, and as your trading journey continues, guys, trust me, you're going to learn all about indicators, but that's not going to be here. All right. So anyway, with that being guys said, we're going to get ready to wrap up the FRX Beginners Bootcamp number 5. I want to thank you guys for being here.